finance, technology, and entrepreneurship. It's my pleasure to moderate the panel discussions, spearheading investments on both sides of the Atlantic. As you know, VC is a catalyst for innovation and growth in the industry, and the UK has been one of the most active and capital-intensive venture capital markets worldwide, with 22 billion pounds of VC deployed and 3,900 VC deals made in 2022. In today's panel discussion, we'll delve into the current landscape of VC investment, how to attract funding from a fintech's founder's perspective, and how stakeholders can cooperate in the ecosystem, and what are the metrics VCs care about. So without further ado, I would like to welcome Nick Daley, Investment Associate at FinCapital. Please, a round of applause to Nick. I would like to welcome Steve Gibson, partner of Element Ventures. A round of applause. Jay Wilson, Investment Director at AlbionVC. Last but not least, Karen Rudich, CEO and co-founder of ELEMENTARYb. Thank you. So thanks everyone for joining. My first question, and I think it will help everyone to get to know you all much better, is could you introduce yourself in 2 minutes about who you are, your role, and a little bit about the perspective about the discussion? And I'll start with you.
Absolutely. No, thanks, Tram. Afternoon, everyone, and thanks for having me here today, and appreciate Innovate Finance for bringing this all together. So a bit about myself. On the investment team at a firm called FinCapital. We are a $1.3 billion AUM B2B FinTech InsurTech fund. We operate between the States and most recently opened an office in Europe, in London, around about this time last year. We are full life cycle on our approach. We invest everything from kind of pre-seed, pre-product, pre-revenue, all the way up to pre-IPO basis. So recently invested in a Series F in a company called Circle in the stablecoin space, for instance. We are also, most recently, the second most active investor in FinTech globally for last year, and actually the quarterly data just came out for Q1, and we're the most active FinTech investor globally this year so far. So looking really across the broad spectrum of B2B FinTech, but very much within kind of enterprise B2B SaaS.
Thanks a lot. Steve, would you like
to follow that? Steve Gibson, I'm one of the founders of Element Ventures. We are a London-based FinTech VC. We've been investing in FinTech for about 13 years. The three things to know about us are, I think we have very deep sector networks, the sort of networks that you earn over sort of 10 years or so working with lots of stakeholders across financial services. We have also, I think, great entrepreneurial networks. We have 21 FinTech founders who are LPs in our fund, and I think that says something about understanding the journey of building a world-class FinTech firm, which is full of scar tissue and tears and hugs, and I think that's really where we spend a lot of our time, in that scaling up story. And the last thing really is the sort of industry connectivity that we bring our FinTech firms, and where we feel that we can play a real role in something that accelerates your growth, because we have something else in our network that can help you, then generally good things happen. That's us.
Thank you.
I'll try and keep this even shorter. Jay Wilson, I'm an investment director at AlbionVC. We were established 27 years ago. We manage about $1 billion of capital dedicated to investing in UK B2B technology. FinTech is our largest vertical concentration. It's about 30% of our assets under management. So two key points. One is that it's 100% UK focus, and second key point, 100% B2B investment. So that really defines our investment mandate.
And Karen, you are not a VC, but you are a FinTech founder. So could you share about your journey with everyone?
Yeah, indeed. Third-time founder. I've had 2 exits before, one listed on AIM back in the dot-com era, then went into investment banking, and then I set up my second one, which I sold in 2019. I guess my journey was very much around, I was an investment banker, and this time around, I wanted to make a difference in the world. So I took a step back, and I thought, artificial intelligence, what are some of the new technologies coming in, and what is really the biggest area where we can get a bang for our buck, and that's in the SME sector. So our proposition that we launched was very much focused around driving economic growth in the UK in the SME sector using artificial intelligence to help small businesses navigate economic turmoil and bring them closer to their accountants and their bankers. So didn't go too far from home, still a banker at heart.
So my first question to all of you would be, what does the current investment space look like? If I'm a fintech founder today, how can I attract funding? Should I be raising or should I hold off? And you have your experience between being a VC in the UK, but also in the US as a fintech founder. What would be your insight on the topic of the current investment landscape in your region, let's say?
We start or otherwise?
Yes.
I mean, as a lot of the data shows, it's been incredibly tough for a lot of founders in the last year or so. From a kind of macro perspective, the US just had their 7th consecutive quarter of reduced funding in the fintech venture ecosystem, and further decline in valuations, especially that kind of mid-late stage. Anecdotally, though, I think since the beginning of the year, I've seen a marked change in kind of attitude and positivity, especially around the kind of pre-seed and seed segment. So that's where we're particularly active at the moment, and especially in that pre-seed area where we're seeing a lot of incredibly experienced and capable founders deciding to leave their current jobs, primarily because these valuations at places like Stripe and others have come down, and those kind of that optionality now has increased of why to leave. So we're actually seeing a lot within the pre-seed space, but anticipate a hard year, especially for kind of Series A onwards, to be honest.
And Steve, could you provide your views on how founders or companies can attract funding in your space and with the current environment?
Yeah, I think the market is still open, but if you don't have to be in the market, then stay out of it. So I think if there are ways of you not being in this market and then coming back into the market at the end of the year or even early next year, it feels on the balance of probabilities the market is going to be more buoyant later this year than it has been so far this year. I think, as Nick said, seed and Series A, I think the smaller rounds are still very plausible. I think the sort of $25 million rounds, Series B and beyonds, are much, much harder. So I think there's still ground game capital, but there's not a lot of growth capital. And I think that really encourages founders to really think about capital conservation and breaking even maybe much earlier than they would have done otherwise. We were talking on the sort of précis for this panel about founders having 2 business plans right now, a sort of break-even business plan and a growth plan, and really being able to understand both of those plans and being able to shift between one and the other as you need to. And I think the better you understand the capital efficiency of what you're asking for, the better your investment discussions will go. But I think we all feel up here that even though it is difficult, it's still very plausible. So the best founders and the best companies with the best arguments, with the best activations in the most activated TAMs will still get funded. That's a given. So if you are that person, then don't be put off by the market. But if your story is a little bit more complicated, or it's a bit more nuanced, or you don't yet have the metrics, or it hasn't yet turned out the way you wanted it to turn out, which is generally most companies, then I think it's a much harder market right now.
I suppose only really to build on that, you may hear this phrase, only raise capital if you have to, or only go to the market if you have to. Well, on the downside, if you have to, that just might be your only choice at the moment. You may absolutely need to do that for the survival of the business. But equally, on the more sort of slightly ambitious side, you may have to because you're seeing such traction, such adoption from your customers that you need capital to go and exploit that commercial opportunity. And to Steve's point, there is a capital market for that today. There is a liquid private capital market for that. So if you sit on the ends of the spectrum, there is definitely an opportunity for you to come to market. The harder narrative, the harder arguments are in that middle ground where things maybe are not working quite yet. That's quite a hard space that we find ourselves in today. And you see that, we've heard some statistics from Nick in the US, we see that in the UK, transaction activity is down about 80% in the UK relative to the same period last year, which is a really material difference from a fundraising perspective.
Yeah, I would agree. I think from a founder perspective, if you've got, it depends on your vision, but if you're going to be fundraising, you're always on fundraising mode. Whether you need the capital or whether you're fundraising for the future, you're always striking up those relationships. Particularly for us, where we closed our pre-seed last year. We never stop fundraising, even when we're meeting people that are going to go into a round B, round C, because we've got big ambitions and big visions, and that it takes years to build up those relationships. I think definitely, you've got to be more capital savvy, how you're deploying your capital and your investment, prioritizing the key deliverables in your roadmap, and actually, sometimes cutting headcount. If you haven't onboarded enough clients onto your platform, actually, can you reduce your technology support team? For a certain period of time, and then holding on to that money because it's going to take a lot longer to go and open up your next round and then close your next round as well. So I would say continue fundraising. There is plenty of money out there. You just have to hang in there, be tenacious, and be driven because the money will come as you're building your proposition.
Now we're talking about going a little bit deeper on the VC landscape, and we talked about the collaboration part, which could be good, could go wrong, could go well, we don't know. But could you share, because it has changed a lot now that we are in this bear market, how has it changed compared to the lesson perhaps that you've learned? What are your lessons learned for the past 2 to 3 years? And perhaps my second question would be, are we in this collaborative process or an individual one in terms of funding? Do you think what is the best strategy as a fintech founders? And my third question would be the metrics. What are you looking at? Are you looking at the same way as when you're investing into a company, or is it totally different now? And I'll perhaps, ask if you want to start, and then...
Yeah, totally. I think at Fin, we've always done our best to be as collaborative with the rest of the industry as possible. We do not see it with our fund structure and our kind of size of the fund as a kind of one-man team where we're just going to rise up all these companies and bring them all the way to the top ourselves. So had the pleasure of investing alongside a lot of people at this event, to be honest, and at this table. But I think I saw this morning, I looked through our last 9 deals that we've done this year. 6 we followed on as a syndicate, and then 2 we co-led and 1 we led. So there's only 1 deal really where we're taking the kind of majority of the round. All the rest very kind of syndicated in nature, and very much focused on what each company needs at the table. We are particularly good at the kind of enterprise introductions. Our LPs are banks, insurance companies, and asset managers. But other parts of the company building process, we do not have as well developed as other funds. So we're trying to build that syndicate together to help the team and that company get to where they want to be.
Very good. Yes, Karen.
I think I had actually a little bit controversially, and we did discuss this earlier. VC money may not necessarily be right for you, depending on where you are at your stage in your journey for your business, and actually what your growth ambitions and targets are. And actually, I think it's a question around not just collaboration, but looking at yourself inside as a founder and saying, do I align with the mission statement of the VCs that I am due to work with, whether it's collaborative, whether you've got a number of them on your cap table or you're looking to get a number of them on your cap table or not. There are other pools of investment, particularly in the earlier stages or where you've got more steady growth that might be more suitable for you.
This panel didn't come together as it pre-organized. But just to give a sense of what collaboration really looks like. So we have a co-investment together. I think you guys have co-investment together. Yep. So actually, it is a highly collaborative ecosystem, and that is the VC ecosystem on average. It goes through cycles. I suppose 2019, 2020 were in the more collaborative phase. End of 2020, 2021 was more individualistic, and we're definitely back now into this more syndicated deals, collaborative environment. And it's often not a right or wrong answer. You have trade-offs here. You have trade-off between having more capital around the table, having access to more networks, more perspectives. Those are the pros. To the point that Karen made, on the downside, you've got the issues around alignment and ambition, and in the unlikely event, I'm sure, for your startups where it doesn't quite go to plan, is everyone going to pull in the same direction? So it's about understanding the trade-offs and understanding what you specifically need from your investment partners at any one time in your life cycle as a company.
Steve, you look like you care a lot about metrics. You keep talking about metrics. And so what are the metrics you're looking at when you invest?
That's another Steve. I don't think that's me. But I think that's a really important point that Jay has made. It's easy, I think, to look at the 23 market and think this is so much harder than the 21 market because there are not, big firms trying to write the whole check very quickly before the opportunity disappears. I think venture used to be a real team sport, and building syndicates of venture firms who all have a specific lane and will all work really hard for you is also a great model. It might take longer to build, the checks might be smaller, but these people will work really hard for you if you can construct the right group. And I think that is where the market is today, and it will be for some time. And that really used to be where things were from maybe 2012 to maybe 2017. So we're really going back to the market that always used to exist. But as a founder, when you're now approaching that market, understanding that you would need to build the book and find a lead and then build a network around the lead, the skill set around that is very different to the skill set you needed in 21, which was tell a big story, create scarcity, run a quick process. $10 million arrives. Now it's a much more sophisticated process, but it's a much more typical process and a much more, I think, much more likely to be this market now for the next couple of years.
I think interesting on that as well, I think, you put it as the founder needs to develop that skill to build that syndicate, but there's also a lot of resources they can tap into, right? Whether it's with their lead investor to try and get those introductions to other kind of complementary skills, or maybe former founders, other people on the cap table, angels who might have links in. I think that's resources that we don't see utilized enough a lot of the time.
Yeah, you're building your sort of your team of advocates. You're building your team of
exactly.
And you want to have people that really understand and care about your business.
So you helped me a lot on my third question, my last question. But before because I'm conscious about the time, but tell me about, you said about collaboration can go really well, but can go really, really wrong as well. And you wanted to share about your experience, perhaps.
Yeah, I think, one thing that I saw in the US become quite prevalent was the idea of a party round. So whereby, and I saw this only last week, a firm came up and said they'd raised, I think, 8 million from 7 different investors. All venture funds. And you kind of divide that down and you realize actually the average check size there is quite minimal. And I think the problem with these party rounds and when collaboration goes too far is 2 things. One, lack of governance. No one firm is coming along and probably taking a board seat or even really setting up any necessary kind of governance requirements. And FTX, I think, is a very relevant example there. And then secondly, I think more impactfully in many ways would be the lack of conviction. Really what that's signaling to the market further down the line is that no one firm probably wanted to take a lead position and take the 50, 60% of the round that maybe is typical. And I think now we're coming out of this cycle whereby those rounds are coming back and those companies are coming back to raise. We're seeing a lot of these companies, the funds didn't really do any work on the DD. They offloaded the DD to other people. There was just 7 other funds in that round. So they said, oh, fantastic, we'll trust their DD process. And then also, they're not close to the business anymore and not looking to continue to fund it now that it's either lost its hype or maybe didn't go to plan within that year and a half, which is more common than not in early stage.
I'm conscious about the time. So my last question would be, the skills required, and you touched point a bit about that, in today's financial services and fintech are totally different from ones previously. It's talent. Talent is an essential pillar in finance. And do VC invest in talents? And in other words, from employees to CEOs, do VCs look at people when investing into companies? And yes, what are the metrics that VCs care about? And my question would be, is the 2020 CEOs the same one we see in 2023? And what would be your advice? Karen.
Oh my gosh. So from a founder's perspective, I think talent is absolutely critical. So having gotten it wrong in the last couple of ventures, we founded this company. The first thing I did was, get a CTO, get a chief people officer, get people who kind of complemented the left-brained individual who's very business-driven, which is myself, to actually build that talent pipeline, because you've got to be, tenacious. You've got to attract the experience. You've got to attract the skills. And you got to get very crafty around being able to pay for top talent with, at your early stage, startup stage, bottom dollar. Yes, you've got to be able to complement yourself and look at, your full bag of tricks, which I think in the past, as a CEO in the past, you were always focused on the bottom line. You're always focused on hitting your business targets, on, achieving your next milestone. Now it's more around the wider, how do I hit my wider vision? Who do I need to bring on board to get to that, North Star that is going to help us get there?
I mean, if you're an early stage investor, you're really investing in talent. That's all you're really investing in. And so you have to have an ability to have empathy with your founders. Otherwise, it's just never going to work. Later stage investing is something slightly different. But fundamentally, when you're making an early stage investment, you're making an investment in a founder or a team of founders, and that's really what you're trying to make an investment decision based on.
Yeah, I'd agree with that. We did some work where we did a look back on every company we'd backed in the last 10 years and what were the sort of common attributes in the founding team. And it was really stark that actually it wasn't where they were in the beginning, it was their ability to evolve through setbacks and be resilient and reimagine themselves and reinvent themselves. And actually, that's the most important thing to know about someone. Can someone become what they need to become on any given day to achieve the task? And I think that's the most consistently needed thing in the talent pool. And we're in a situation now where every single fintech firm in this room and in this event will be short of talent. Finding really good talent is really difficult. So it's really the missing piece of the jigsaw for everybody.
Yeah, absolutely. That adaptability to go through the different stages, I think, is one of our most important things that we look for. I think, to answer your question, the types of founders haven't really changed. It's just the weightings of maybe their characteristics that have slightly, or kind of now come to the front of the pack as such. And really, it's all about, for us, previous founding or operating experience, being able to, or being part of a journey from 0 to 1 or somewhere of a previous company. Is very important to us, and then value alignment with our firm. We have our own values that we look for everyone involved in our firm to kind of embody as well.
Thank you so much for your time. It was really, really insightful. Can I ask one last question? No, we don't have much time. So no, thank you so much. Really, really insightful. And then we'll wish you a very good continuation of the session. Thank you so much.